AI is the hottest investment trend of the year, no doubt about it. But here's the big question. Are we witnessing a once-in-a-lifetime historic opportunity, or are we just repeating the dot-com bubble all over again?
And this isn't some random opinion. Even Sam Altman, the CEO of OpenAI, the man behind ChatGPT, admits it. AI is in a bubble.
From ChatGPT to Google to Microsoft, every big tech player is going all in. Data centers are going up like skyscrapers, billions are pouring in daily. And yet, investors are getting nervous because history tells us something brutal. When the hype fades, a few people cash out rich, but most, they're left holding the bag.
So today, we're digging into the part no one's really telling you. Why Altman himself is warning about a bubble. Why Wall Street legend Ray Dalio thinks this time is even riskier than 1999. Why Alibaba's chairman is warning about overheated infrastructure. And what it means when an AI darling loses half its market value in just weeks. Stick around, because by the end, you'll know exactly how to tell hype from reality in the AI boom. A bubble is when prices spin way above real value. It's like a wild dance party with everyone wearing these fragile red shoes. The harder they dance, the faster the shoes fall apart. Only a few with tougher shoes survive till the end.
So basically, people throwing money around like confetti. Buy first, think later. Doesn't matter if the company deserves it.
Exactly. Capital floods in like a hurricane, but real demand? Nowhere close.
Sounds exactly like the dot-com craze 20 years ago. All you had to do was add .com to your name and boom, instant millions. No product? No problem.
And what happened? Most of those companies flatlined. Bankrupt, gone, forgotten. But the lucky few, like Amazon, survived and completely reshaped the world. So here's the real question. Are we watching the same movie all over again? Only this time with AI startups in the lead roles?
And if so, what's different this time? Why are so many people feeling even more anxious this time around?
Experts point to 3 big reasons. First, capital is red hot. In 2023 alone, some AI startups doubled their valuations overnight. We're talking about companies raising hundreds of millions with nothing more than a fancy pitch deck. No product, no customers, just hype. Second, no clear business model. Yes, AI is powerful, but how do you make consistent money with it? Subscriptions? APIs? Ads? Nobody really knows yet. It's like everyone is running a race without a finish line. Third, hype versus reality. The vision sounds like sci-fi gold, but the results? Often slim. Remember Amazon back in '99? Its stock crashed 90% before it recovered. That's the gap between hype and reality.
So here's the million-dollar question. Who's going to be today's Amazon? And who's just another pets.com waiting to crash?
AI stocks have been wild lately. Up 20% one day, down 15% the next. If you're not managing risk, your portfolio can turn into a car crash overnight.
But here's the twist. The guy ringing the bubble alarm isn't some outsider throwing shade. It's Sam Altman himself, the mastermind behind ChatGPT.
Exactly. Altman admits it flat out. Investors are way too hyped. We are in a bubble. He says bubbles form when smart people find a tiny kernel of truth. Then everyone gets way overexcited. AI is shaking up the world. That's real. But hype stretches it way beyond reality.
He even said some AI startups are literally just 3 people and an idea, and they're raising hundreds of millions. And Altman warns, someone is going to lose a phenomenal amount of money. If you're chasing those sky-high valuations, you could get totally wiped out.
But don't get it twisted. Altman isn't bearish on AI. In fact, he calls it the biggest tech revolution in decades. He's personally preparing to pour trillions into data centers and infrastructure. His message is crystal clear. The technology is real, but the capital frenzy is overheated. Long-term bullish, short-term bubble. That's the paradox we're living in.
When it comes to bubbles, you can't skip Ray Dalio, the billionaire founder of Bridgewater, one of the most respected voices on Wall Street.
Dalio lived through the dot-com crash. He knows the signs better than anyone.
He says today's AI frenzy looks a lot like that old mania. Investors see shiny new tech, valuations shoot to the moon. Sound familiar?
But here's the kicker. Back in '99, interest rates were super low. Money was cheap, easy to borrow, easy to gamble. Today, total opposite. Rates are high, borrowing costs are painful. So if valuations are insane and money is expensive, that's a recipe for disaster.
Dalio uses a killer metaphor. Imagine a giant pile of dry firewood stacked up high. Add just a tiny spark, and boom, instant wildfire. That's today's AI market. Dry wood everywhere, just waiting for a spark.
And the lesson? Every tech boom looks exciting at first, but the real test is the fundamentals. Can these companies actually make money? Or are they just burning investor cash? One of the loudest warnings came from Torsten Sluk, chief economist at Apollo Global Management. That's one of the world's biggest asset managers.
And what's he saying?
He compared today's AI stock valuations to the dot-com bubble's peak in 1999. And guess what? Today's are even higher.
Wait, higher than 99? That's insane.
Absolutely. Apollo looked at the top 10 tech stocks in the S&P 500, their price-to-earnings ratios, their valuations. And today's numbers are even more extreme than back then. This isn't just vibes. This is cold, hard math telling us the bubble is inflating faster and bigger.
Now let's shift to the physical side of AI, the hardware, the infrastructure. Joseph Tsai, chairman of Alibaba, has a warning here too.
He says companies are racing to build AI data centers like there's no tomorrow. Huge piles of money going into construction, before they even know if there's enough customer demand.
That's the exact same mistake we saw in the 1990s fiber optic bubble. Miles of cables buried underground, but hardly anyone using them. When the bubble popped, investors lost billions.
And today, projects like OpenAI and SoftBank's Stargate, they're talking about $500 billion in investment. US giants are also pumping in hundreds of billions. But without demand to match, we could end up with ghost data centers. Massive assets sitting idle. Okay, so what about real results? Is AI actually making money for businesses yet?
I mean, everyone's talking about it, but is it actually paying off?
MIT studied 150 large companies testing generative AI. And the verdict? Most haven't found a repeatable business model. Even the best AI systems only complete about 30% of assigned tasks end to end. So yeah, they're powerful, but not profit machines yet.
So a lot of money in, but not much money out?
Exactly. Not wasted, but misdirected. Companies are pouring cash into flashy chatbots, cool for demos, but not necessarily profitable. The real returns are hiding in the back end, automating operations, cutting outsourcing, streamlining processes. That's where the real financial wins are today. And if you want proof the cracks are showing, look at CoreWeave. It was NVIDIA's golden child, an AI cloud superstar. But in June, its stock lost a third of its value in 2 days. By August, cut nearly in half.
Whoa, why such a meltdown?
Under the surface, they were bleeding cash, piling on debt, and struggling with power supply limits. Then, when the lockup period ended, early investors dumped their shares. Boom, stock freefall.
And Eric Gordon, a U.S. business professor, says the scary part is this. This time, it's not just retail traders speculating. Big institutional investors, pension funds, hedge funds, are in deep. If the bubble bursts, the ripple effects are massive.
So, does this mean the AI bubble is definitely going to burst? The truth is, no one can say for sure.
But if it does, the hardest hit will be the startups with sky-high valuations. Stock prices crash, funding dries up, layoffs follow, and one shutdown leads to another.
Overbuilt infrastructure is another landmine. Too many data centers and chips with not enough demand. That means idle assets collecting dust.
Some scholars think this isn't an apocalyptic crash, but more of a brutal correction. Unprofitable startups get weeded out and the survivors consolidate power.
And analysts from Morgan Stanley and Oxford remind us, long-term, AI is still massively promising. The key is separating hype from real demand. Don't get blinded by short-term frenzy.
In the end, experts agree. AI companies with real tech, loyal users, and steady revenue will survive the shakeout and become the next Googles and Amazons.
And you? What do you think? Is this all just a bubble waiting to pop? Or a messy but necessary step toward the next tech revolution?
Drop your thoughts in the comments. We want to hear from you. And if you liked this deep dive, make sure to hit subscribe, like the video, and share it with someone who's caught in the AI hype. This is George and Ella's Money Lab. See you next time.